Hey everyone, welcome back to the Deep Dive. Today we're slicing through all the noise from Travelers' latest earnings call. That's their second quarter of 2025. Our mission, as always, is simple. Pull out the crucial number, the strategic moves you really need to grasp, how they're doing and what might be next for them. And look, when we look at the headlines, Travelers, well, they delivered an undeniably strong quarter. They reported core income of $1.5 billion, which takes out to about $6.51 per diluted share. Their core return on equity for just the quarter was pretty impressive, 18.8%. That pushes their trailing 12-month ROE to a solid 17.1%. We also saw really robust underwriting income driven by strong net earned premiums, and their reported combined ratio significantly improved, almost 10 points better, down to 90.3%. And this wasn't just like a one-off thing. The improvement was broad-based. They benefited from lower catastrophe losses, better underlying underwriting results, and some favorable prior year reserve development too.
That's exactly right. The overall picture is definitively positive. And what's truly compelling, I think, is how they're achieving these numbers. Their underlying underwriting income, the profit from their core insurance business before things like major storms that jumped a remarkable 35% over last year. That's $1.6 billion pre-tax. And this was powered by 7% growth in net earned premiums, hitting $10.9 billion. And that underlying combined ratio you mentioned, it improved 3 points to an excellent 84.7%, which remarkably marks its third consecutive quarter below 85%. That consistent sub 85% figure, well, it isn't just a good number. It really speaks to a foundational shift in their underwriting discipline, right? It suggests they're proactively structuring things for consistent profitable growth.
That's a great point about consistency.
And on the investment side, after-tax net investment income hit $774 million. That's up 6% from last year, mostly from a growing fixed income portfolio, which for the first time pushed total invested assets past $100 billion. Huge number. And for you, the shareholder, the company returned over $800 million. That included $557 million just in share repurchases and adjusted book value per share, up over 14% year over year.
Okay, those headline numbers are certainly grabbing attention, but the real story of Travelers' quarter often lies in the operational trenches, doesn't it? How did each of their key business segments actually contribute to this stellar performance? Let's dive into the engines driving these results. Maybe start with business insurance. Here, segment income grew almost 25% to $813 million, and they boasted an excellent underlying combined ratio of 88.3%. Net written premiums increased 5% to a record $5.8 billion, and that was led by strong growth in their core middle market, up 10%. Renewal premium change, it stays strong at 7.7%. Middle market was 8.6%. Small commercial select even stronger at 10.7%. Retention looks solid, 85%. And new business, record $744 million. So what's your take on their pricing power here? Especially with all that strong growth. Is it holding up?
Yeah, that's a great question because pricing durability is definitely, top of mind for a lot of investors right now. While, certain areas like national property did see some, let's call them softer elements, which led to them strategically ceding, passing on some large accounts. The overall pricing landscape, particularly in middle market and select businesses, and remember, that's like 70% of their BI premiums, that remains robust, very strong. Their underlying loss ratio, which tells us how much they're paying out versus premiums collected, was very strong at 58.4%. There was maybe a little extra favorability from non-catastrophe weather, but still strong.
And what about inflation? We hear so much about tort inflation these days.
Right, tort inflation, basically rising legal costs and claims. Yes, it's definitely alive and well, as they put it, showing up in the numbers. But the good news is Travelers seems to be actively pricing for it, like proactively factoring those potential costs into their premiums. Social inflation, bigger jury awards, more lawsuits, that's observed across the book, maybe more pronounced in larger accounts. But again, they seem to be managing it. And the exposure trend, it lines up pretty well with broader economic activity and, moderating inflation. So it all sort of fits together.
Okay, so from those big commercial operations, let's pivot a bit. Let's look at bond and specialty insurance. It's more specialized, yeah, but often gives unique insights, doesn't it? How did they do this quarter? Well, they posted $244 million in segment income. Outstanding combined ratio of 80.3%. The underlying was 87.8%. Net written premiums grew 4% to $1.1 billion. And I'm also seeing strong retention here, 87% in management liability, and robust demand in surety. That's good.
Yeah, and a particularly, I think, telling point within this segment's data is their stance on the cyber market. It's fiercely competitive right now. Travelers basically highlighted that pricing in this line for many players out there isn't fully reflecting the underlying loss environment. And that's, a major red flag for profit down the road. So this really underscores Travelers' disciplined underwriting approach. They're clearly prioritizing profitability over just grabbing market share. They're willing to walk away if the risk isn't priced right.
Okay, discipline seems to be the theme.
It really does. And this isn't just being careful. It's a very intentional, segmented strategy.
Yeah.
It speaks volumes, I think, about their commitment to long-term value.
All right, buckle up then, because here's where, for me, it gets really interesting. Personal insurance. This segment delivered $534 million in segment income. The combined ratio improved, wait for it, a dramatic 20 points, down to 88.4%. The underlying combined ratio improved 7 points to 79.3%. Net written premiums grew 3%, and we saw a significant improvement in auto, a 12% increase in new business premium. Plus, they actually wrote more new policies year over year for the first time in well over a year. And maybe most crucially, they're making a strategic decision to relax property restrictions in most markets by the end of 2025. So on the surface, this sounds like a strong vote of confidence, right, in their profitability improvements. But does it carry risks? What's the potential downside to this move?
That's a really perceptive question. The strategic move on property, it is a direct result of the tangible progress they're making. Improving profitability, managing volatility in that line, it definitely speaks to their confidence. Now, while auto retention, it's at 82%, still a couple points below their historical mid-80s, the company stressed they see no signs of adverse selection in new or retained auto business. And that's a key de-risking point.
Right. They're not just getting riskier drivers because they lowered prices or something.
Oh, exactly. As for the risks of relaxing restrictions, well, anytime you do that, you really need to be confident in your underlying data, your pricing models. Travelers' plan here, they said, is to deploy this relaxed property capacity primarily to support writing package business. That's combining home and auto policies. So the strategy is meant to bring both property and auto opportunities together, leveraging their combined strength. It's not just like opening the floodgates for property policies alone.
Got it. Supporting the core package strategy. Makes sense. Okay, shifting gears now, capital management. We need to talk about that agreement to sell most of their Canadian business, $2.44 billion. This move also highlights a planned $700 million in additional share repurchases in 2026, and they expect it to be slightly accretive to EPS, earnings per share.
Yeah, and this brings up, I think, a really crucial insight into Travelers' broader philosophy. This Canadian sale, it really exemplifies their self-identification as optimizers. They seem relentlessly focused on disciplined capital allocation, on value creation, constantly reassessing where their capital is best deployed. They were clear this isn't some broader geographic repositioning. They explicitly called it a smart transaction.
Just optimizing the portfolio.
Exactly. And for you as a listener, it signals a management team that's willing to make tough strategic calls to enhance overall returns, even if it means selling off a pretty substantial piece of the business.
And sticking with capital, on the investment front, they've actually increased their fixed income net investment income outlook. Looks like $770 million after tax in Q3, then $805 million after tax in Q4. What's maybe even more interesting is that their new money rates, the yield on new investments they're making, are over 100 basis points, over 1% above their current portfolio yield.
Right. And to put that in context, that signals a very positive trajectory for investment income, probably well beyond 2025. As the portfolio grows and older, lower yielding stuff matures, it gets replaced with higher yielding investments. It's kind of like a slow burning fuse, it'll just keep adding to their bottom line over time.
Nice tailwind.
Definitely. And it's important to clarify, too, that the $557 million in Q2 share buybacks, those weren't driven by the Canadian sale proceeds. That money isn't expected until 2026. And it wasn't about timing the market either. They said it was driven by their ongoing strategy to just right-size capital, keep the balance sheet efficient. Oh, and they also mentioned reinsurance placements getting broader coverage at reasonable costs. And they briefly touched on an investment book rating shift due to Moody's action on the U.S., just confirming it's within their guidelines, not really a concern for them.
Okay. So if we pull all this together then, what does this, phenomenal quarter really mean for you, the investor, looking at Travelers? They're boasting exceptional underwriting performance, record operating cash flow, steadily rising investment returns. That foundation, combined with a diversified business and clearly disciplined execution, it signals a highly confident outlook, doesn't it, for continued premium growth and attractive margins?
Absolutely. If we connect this to the bigger picture for you as an investor, These results offer some key insights into what makes a resilient and, frankly, adaptable P&C insurer. Travelers is demonstrating really strong command over its underwriting profitability, even with challenging market dynamics like tort inflation swirling around. Their strategic capital allocation, that willingness to prune non-core assets like Canada to enhance value, that clearly stands out as a differentiator. And the segment-level improvements, especially in personal insurance, that auto turnaround, their thoughtful approach to property risk management, it indicates a nuanced and, well, effective strategy across diverse lines. This level of execution, I think, provides a strong signal of resilience and adaptability in the wider P&C sector.
All right, well said. Now let's move to our not financial advice segment. And remember, folks, this is purely a thought experiment, just for the curious, maybe the bold among you.
Okay, so this whole discussion brings up a pertinent point, maybe for the imaginary investment committee in our heads, right? Given travelers' self-ID as optimizers and their proven willingness to divest non-core assets like Canada, what's potentially next, these Q2 results have clearly set a pretty high bar for their internal capital deployment hurdles, their ROE targets. So my outrageous but plausible trade idea is this. Maybe anticipate travelers making another, perhaps more surprising, strategic divestiture. Could be a smaller international bit, or maybe a niche domestic segment that, upon really rigorous reassessment, just doesn't meet those newly elevated ROE targets.
Ooh, interesting. So selling more off.
Potentially. And this could then be followed by an even larger and more accelerated share repurchase authorization, something beyond that $700 million already earmarked for 2026 from the Canada sale.
Yeah.
Such a move, while it would absolutely reinforce their optimizer identity, it could create an incredibly lean, high ROE core business. And it would signal, I think, an unparalleled commitment to shareholder value, maybe truly surprising the market with just how relentless their capital discipline is.
That is an outrageous but plausible thought. Doubling down on the optimization strategy. Okay, so to sum things up for today, Travelers delivered, well, truly exceptional Q2 2025 results, demonstrating strong underwriting, incredibly disciplined capital management, and what looked like a clear path for future profitable growth.
Yeah, their strategic moves like that Canadian divestiture we discussed, and just their meticulous approach to managing the whole portfolio, it really underscores their commitment to maximizing shareholder value. They seem to be playing the long game with very clear intent.
Great stuff. Thank you for joining us on this deep dive into Travelers' numbers and strategy today. We really hope this breakdown helps you feel truly well informed. What stood out to you from this discussion? We'd honestly love to know. Until next time, stay well informed and keep asking the right questions.